Everyone said the dollar was finished when Saudi changed its oil payment rules. 1 year later, what actually happened might surprise you. Welcome to Voice on Pages. Let's unpack this Saudi petrodollar story fast and clear. So, what kicked this whole thing off? Well, back in June of 2024, you probably saw headlines just like this one blowing up everywhere. The story was simple and honestly pretty terrifying. A supposed 50-year deal that forced Saudi Arabia to sell its oil only in US dollars had expired. The immediate prediction? The dollar was on the verge of a catastrophic collapse. All right, so here's our game plan for this explainer. First, we're going to tackle the petrodollar panic and sort out the myth from reality. Then, we'll hit you with 3 data-driven facts from the last year that tell a very different story. After that, we'll uncover why the dollar is so tough to replace, and finally, we'll look at what's really coming next. Okay, let's get right into it. The panic itself. Was this whole firestorm based on a real event, or was it a story built on, well, basically nothing? And here is where the whole narrative starts to completely fall apart. The myth, the story that went viral, was that a formal, binding treaty just expired. But the reality? That 1974 deal was about economic cooperation. It was about Saudi Arabia investing its oil money back into the US in exchange for military support. It never, ever said that oil had to be sold exclusively in dollars. And look, don't just take my word for it. As the chief economist at UBS, Paul Donovan, put it very bluntly, there never was a formal petrodollar agreement. It seems the entire narrative was cooked up in speculative online communities and then just got amplified until it sounded like fact. So that brings us to the big question, right? If the foundation of the story was totally wrong, was any of the panic justified, or was it all just hype? To figure that out, we have to stop reading the headlines and start looking at the numbers. So let's cut through the noise. What does the data from the last year actually tell us? I'm going to give you 3 key results that paint the real picture. Result number 1 is all about stability. In fact, remarkable stability. Everyone was predicting a mass exodus from the dollar. But the official IMF data, it shows the dollar's share of global reserves went from 57.8% down to 57.7%. That's a change of 0.1%. That is not a collapse, my friends. That is statistical noise. Did you expect it to be this stable? Let me know down in the comments. Now, for our second results, I just want you to focus on this one number for a second, 80%. That 80%, that's the share of global oil that is still priced and sold in US dollars today. You see, the entire plumbing of the energy market, the big futures contracts, the global benchmarks, it all runs on dollars. Not to mention, the Saudi currency itself is pegged to the dollar. That creates a powerful inertia that's just incredibly hard to change overnight. And this really drives the point home. If you look at Saudi Arabia itself, the country at the center of this whole drama, they only reduced their holdings of US Treasuries by about 6.8% over the year. That's not a panic dump. That is just normal portfolio management. And that leads us straight into our third result, the so-called alternatives, the much-hyped BRICS pay system. Well, it had its big public demonstration, buying a single $5 coffee in Moscow. Now, let's put that $5 coffee into perspective. The SWIFT network, the system it's supposed to replace, handles over $150 trillion a year. The difference in scale is just staggering. These new systems are interesting for sure, but right now they're more about making a political point than actually replacing the global financial backbone. So you have to be asking yourself, with all this political rhetoric, all this media hype, why did so little actually change? Well, the answer lies in the dollar's deep, hidden structural power. It really comes down to a powerful economic idea called network effects. Think of the US dollar as the world's financial operating system. The more countries and companies use it, the more valuable and convenient it becomes for everyone else to use it too. It's a self-reinforcing loop, backed up by the fact that there is simply no other market in the world deep enough to park trillions of dollars as safely and easily as the US Treasury market. And listen, this isn't just my opinion. You've got the heavy hitters, Ray Dalio, Goldman Sachs, JPMorgan, all saying the same thing. Major shifts in global currency don't happen in months. They're slow, generational changes that take decades, and they're driven by huge economic shifts, not by the expiration of an agreement that never really existed in the first place. So, if a sudden dollar collapse isn't in the cards, what does the future actually hold? Let's walk through 3 realistic scenarios for what happens next. First, the most likely path is what you could call managed erosion. This is a slow, multi-decade diversification where countries gradually buy more gold and do more regional trade in their own currencies. Second is a shock trigger. This is a low probability but high impact event, like a massive US debt crisis, that can force a much faster change. And third is symbolic fragmentation, which is pretty much what we're seeing now. Countries building alternative systems more for political show than for actual scale. So how do you actually track this in the real world? Forget the headlines. You just need to watch 3 key signals. Number 1, central bank gold buying. Are they accelerating their purchases? Number 2, the official IMF stats on global reserve currency. And number 3, the actual transaction volumes on those alternative payment systems, not just the press releases. But even a slow erosion could eventually hit your wallet. Over the long term, a weaker dollar could mean higher prices for all the stuff we import. Hello, inflation. It could also mean more currency swings when you travel abroad, and could trigger big shifts in investment strategies, maybe favoring commodities and international stocks over US ones. Look, the petrodollar scare made for great headlines, but the real story is slow structural change, not some instant collapse. The key takeaway here is to watch the data, not the drama. So of those 3 scenarios we talked about, managed erosion, a shock trigger, or fragmentation, which one worries you the most? Let me know in the comments. And if you want more data-first breakdowns like this one, make sure you subscribe. I've also linked to some of the resources I used in the pinned comment.